Jeff Santoro, we are gradually working our way through our Magnificent Earth 7 accountability series. Through our contest back in August, we each picked an alternative stock that we thought had a chance to maybe do a little bit better than Magnificent 7 stock Alphabet.
The caveat is that the stock we picked had to have some relation to Alphabet in some way. It could not be a random stock. And I'm looking forward to seeing how these did.
Before I get into the two stocks that we picked as alternatives to Alphabet, I wanted to lay this out first. If you're watching this on YouTube, go to the description. You can find the link to the sheet and you can actually see all 7 of the Magnificent 7 stocks and then the 7 stocks that we each picked as alternatives. So you can see the bottom line is the Magnificent 7 has continued to do incredibly well. My picks, not so much. Jeff's picks, better than mine. That's about all you can really say about him. I'm Jason Hall. This is Investing Unscripted. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link. It's fool.com/unscripted. Motley Fool's got a great deal for you. Give you some of their best stocks to buy right now. Okay, Jeff, Alphabet, parent company of Google, parent company of YouTube. You're watching this video on an Alphabet property right now. This is an ad business, right? Ad-based revenues. We each picked a stock that we said advertising has to be a big part of how they make money. What stock did you go with?
I went with Roku, also an advertising company, although maybe people don't think of them that way. I assume a lot of people watching this have used or know someone who has a Roku device as their way of streaming television. And they are a company that sells hardware to stream, but the majority of the revenue comes from advertising. And it's been a rough go for Roku for a couple years now. And I picked this stock knowing that. I have been a little bit more bullish on the future of Roku than I know you have. And I'm still waiting to see profitability increases, but I still think they're heading in the right direction. I think the most important thing with Roku is to keep track of the metrics that they report that are based around the users on the platform. Those are active accounts, total streaming hours, and average revenue per user. And those have been mostly heading in the right direction. So I want to show, using our friends at FinChat, I'm going to show you how these 3 metrics have been doing.
Yeah, so the short version while you're pulling this up, these metrics are all around engagement and monetization. And that's the key for any of these platforms where you're looking to generate ad revenue on a per user basis. And that's the core to Roku.
If you're watching the video here, you can see this is Roku's active accounts yearly, right? So these are full year numbers. And as you can see, even as things have slowed down a little bit in some other areas over the last couple of years, they're still bringing on active accounts at a pretty healthy clip. This is since 2015, they've grown active users at a compound annual growth rate of 31%, which is pretty impressive. Okay, and then here we have total hours streamed. And this is also, as you can see, annual. So this is every year going back to 2015. This has grown at a CAGR of 45%. So even stronger growth on total hours streamed. Average revenue per user, not as impressive. If you look at the CAGR, it's been pretty good, 26%, 25%. But as you can see over the last couple years, this has slowed down. Now, this is a little bit concerning because while there has been some advertising pullback over the last couple years, you've seen some other competitors, Google among them, fare a little bit better with their advertising numbers. So it seems like they don't have as strong of an advertising product here because they're not doing as well as some of their peers. Again, if you look at it from 2015 to now and just spread out that growth evenly, it's still pretty impressive. So overall, I think these metrics are heading in the right direction. Now, the other thing I keep an eye on with Roku is revenue growth, and that has slowed down, but it's still pretty healthy. In the last quarter, it was 14% for Q4 of 2023, year over year. Now it's down from higher than that a couple of years ago, but still, that's respectable. I'm more interested in the bottom line. They've been cash flow negative and unprofitable for most of their time as a public company, but that took a big jump up in the last quarter, both on the free cash flow side of things and also on the profitability side of things. Now, it's still not where it needs to be. It's not sustainably profitable, but they have said that they are looking to be adjusted EBITDA break even by the end of this year, and then positive in adjusted EBITDA after that. Now, that is not GAAP profitability, so we want to see that come too, but this is a step in the right direction. Guidance is important with Roku to keep an eye on, and you can see that they're starting to take this seriously. I know one of the things I like to look at is operating expenses as a percentage of revenue. That dropped to 55% in Q4. It was 74% in Q4 of 2022. So that's a pretty big increase year over year. So I'm not super bullish on this company. I'm holding my shares. I want to see some more growth, but they are certainly making some changes, heading in a good direction. I don't know if they'll ever outpace Alphabet. I thought it was a pretty good stock to pick as an alternative to Alphabet in the Mag 7.
Yeah, I think there's just a purity of comparison that is similar. These are companies that are selling the inventory, right? They're on the sell side. They have the ad inventory that they're trying to sell. The company that I went with is the Trade Desk, which is on the buy side. And it's a lot less of a competitive dogfight, particularly for a company like Trade Desk, which is really targeting the largest ad buyers in the world and the agencies, the ad agencies that they work with. And they've created some really deep relationships. As a result, this business, which has been profitable for about a dozen years at this point, continues to grow at a nice clip. The revenue increased 23% in 2023. We've seen some deceleration there. Normal when you get to these kind of sales, almost $2 billion in revenue last year. It's a pretty good sized business already. And you see its customers' gross spend is even higher. It was 24% last year, almost $10 billion in spend across this platform. This is important to understand that Trade Desk doesn't make money selling ads like Roku does. It charges for its platform that its users use to get better results. Roku is more of a dogfight over trying to sell in a very competitive sell side market for companies that have that inventory that they're trying to sell. Now, the other thing that I want to share here, revenue has continued to grow at a very high rate. We've also seen its free cash flow grow at pretty high rates. If you look at them on a percentage basis, you can see that there's a lot of bit of volatility with its GAAP net income, but its free cash flow generally up and to the right at a pretty high rate. And that's a real positive for investors. One of the reasons that the stock has done really well. Jeff, last thing to do here, we need to talk about where the businesses are now and where we think about them. We haven't shared this really important slide, how these three stocks have done and how our stocks have done against the benchmark. In this case, is Alphabet.
Yes. So it's very clear here to anyone watching that I am the laggard in this group of three. Alphabet and the Trade Desk are pretty neck and neck, actually, pretty close, with Alphabet just slightly ahead. But yes, Roku is lagging behind, and as you huge drop there after that last earnings you just put up on there. I will say this: I'll make my last little pitch here for Roku and how I think that they could end up doing very well in the long run. I think the switch to streaming everything is inevitable and still happening. And while I don't think there will be any one winner in this space, anyone who is providing the place for people to go watch streaming content is going to have a very big opportunity to sell ads to those people who choose to watch their content there. And between the home screen on Roku, the actual remote with the buttons, and then everything that streams on what you watch, there's a ton of opportunities for them to sell advertising. And I think they just need to keep getting people on the platform, keep encouraging them to watch, and do everything they can to make their ad business as compelling as possible.
Yeah, I think that's true. The challenge for me with Roku, we've talked about it before, I think it's worth mentioning here, is that it's competing against a lot of other companies where this isn't their pure focus, right? Thinking Alphabet has a streaming stick. You think about Amazon, Apple. Of course, Apple absolutely wants to make money in streaming. They want to generate a high margin, high profit business. But for all of those businesses, it's part of a greater ecosystem, and it's really a part of their entire user acquisition platform. And with Roku, it's all about, they need to make money, right? They need to be able to demonstrate their ability to make money there.
That's true. And that is a competitive challenge for them. But I will say this: they have the benefit of not playing in the streaming space themselves, and therefore they can be a neutral player out.
Or like an aggregator kind of.
Right. Like you could see that Apple's going to get held back on the advertising side of their streaming device because other competitors may not want to be on there. So that's one thing they do have going for them. I hear all the challenges. This is not the company I'm most bullish on, but I do think that there's a chance they figure this out and have a pretty bright future.